What if you could own your home outright in just 10 years and save hundreds of thousands of dollars in interest? It sounds impossible, but it's just math. Imagine life without that massive monthly payment. The freedom to travel, invest, or retire early. That freedom is closer than you think. But right now, your mortgage is likely the biggest financial chain holding you back, and the bank designed it that way. In this 12-part series, I'm going to walk you through the step-by-step blueprint to pay off your home in a decade or less. This is part 1. Make sure to subscribe and hit the bell so you don't miss a single strategy in this series. Let's dive in. We've been conditioned to believe that a 30-year mortgage is the standard. It's good debt, right? Wrong. A 30-year mortgage is an interest trap. It's designed to maximize the bank's profit, not your wealth. Let's look at the numbers. On a typical $300,000 loan at 6% interest, you don't just pay back $300,000. You pay back over $550,000. That's $250,000 lost. And the worst part? The system is front-loaded. This is called amortization. In the first few years, nearly 80% of every payment you make goes straight to interest, not your home. You aren't buying your home. You are renting it from the bank for the first decade. You have almost no equity growth. Think about what that interest money could do. That's your retirement fund, your kids' college, your peace of mind, gone. But here's the good news. You can break this cycle. You don't have to follow their schedule. In part 2, we are going to expose the first major loophole that banks don't advertise. A simple tweak that cuts years off your loan. Stay tuned. Welcome back to part 2. What if I told you there is a way to make a full extra mortgage payment every single year without changing your monthly budget by a penny? It's called the bi-weekly method. Most people pay monthly, 12 times a year, but there are 52 weeks in a year. If you pay half your mortgage every 2 weeks, you end up making 26 half payments. That equals 13 full payments. You just tricked yourself into paying extra. That one extra payment goes 100% towards your principal. On a typical loan, this alone can knock 4 to 6 years off your mortgage, just by changing the frequency. But watch out. Banks love to charge setup fees or convenience fees to enroll you in their official bi-weekly program. Don't pay it. You can do this yourself for free. Just set up an auto transfer to a separate savings account every 2 weeks and make the extra payment manually once a year. Because you're paying every 2 weeks, when you get paid, you won't even feel the difference in your checking account. It's painless discipline. Over the life of the loan, this simple switch saves you tens of thousands of dollars in interest. Money that stays in your pocket, not the bank's. But bi-weekly is just the warm-up. In part 3, we're going to talk about principal aggression, how to attack the balance directly. Hit subscribe so you don't miss it. Welcome to part 3. Most people try to pay off their mortgage early, but they do it wrong. They send extra money, but the bank just holds it for next month's interest. Unless you specify otherwise, banks will often apply extra payments to future interest, not your principal balance. You're just prepaying their profit. The golden rule of mortgage freedom is this: every extra dollar must be marked principal only. This attacks the debt directly. Let's look at the math. On a $300,000 loan, adding just $100 a month, that's one dinner out, can save you over $40,000 in interest and shave 5 years off your loan. This creates a snowball effect. As your principal drops, the interest charged each month drops, meaning more of your regular payment starts hitting the principal too. Don't rely on willpower. Log into your mortgage portal right now and set up an automatic recurring principal-only payment. Set it and forget it. We've covered monthly hacks. But what if you get a bonus, a tax refund, or a windfall? In part 4, we'll talk about lump sum velocity. Subscribe to see how to handle big checks. Welcome to part 4. Every now and then, life hands you a bonus, a tax refund, a work bonus, or an inheritance. Most people buy a car or go on vacation. You're going to buy freedom. Here is the secret. Early in your mortgage, every $1 you pay toward principal saves you about $2 to $3 in future interest. It's a guaranteed 200% return. Let's say you get a $5,000 tax refund. If you put that directly onto your $300,000 mortgage in year 1, you don't just reduce debt by $5,000. You wipe out nearly $18,000 in interest payments. This is called velocity. A lump sum accelerates you further down the amortization curve, skipping over the most expensive years of the loan. It's tempting to spend that cash, but ask yourself, is a 1-week vacation worth 2 years of mortgage payments? Choose the house. Pro tip: if you make a huge lump sum, ask your lender about recasting. It lowers your required monthly payment while keeping your term the same, giving you a safety net. We've talked about payments, but what about the rate itself? In Part 5, we'll discuss the dangerous but powerful tool of refinancing, when to do it and when to run away. Welcome to Part 5. When interest rates drop, everyone rushes to refinance. It lowers your monthly payment, so it's a win, right? Wrong. It can be a massive trap. If you've been paying for 5 years and you refinance into a new 30-year loan, you just threw away 5 years of progress. You are back to square one on the interest curve. The only time you should refinance is to shorten your term. If rates drop, refinance from a 30-year to a 15-year mortgage. Your payment might stay the same, but your payoff date zooms closer. A 15-year mortgage doesn't just cut your time in half. It cuts your total interest by more than half. It is the nuclear weapon of mortgage destruction. But be careful of closing costs. It costs money to refinance. Calculate your break-even point, how many months of savings it takes to pay back those fees. If you can't qualify for a 15-year loan, create your own. Stay in your 30-year loan but pay it like it's a 15-year. You get the speed without the commitment or fees. We've covered all the technical math. Now we need to talk about the enemy within, lifestyle inflation. In Part 6, we'll discuss why your raise at work might be killing your dream of freedom. Welcome to Part 6. You finally got that promotion. You're making more money than ever. So why isn't your mortgage shrinking? It's called lifestyle inflation. There is a law in finance called Parkinson's Law. Expenses rise to meet income. You get a raise, so you buy a nicer car, eat out more, and upgrade your phone. To pay off your home in 10 years, you must fight this urge. When your income goes up, your lifestyle must stay flat. That gap between income and spending is your freedom. That new $700 car payment? That money alone could have knocked 5 years off your mortgage. Is the leather seat worth working 5 extra years? Adopt this rule. Live on last year's income. Save 100% of every raise, bonus, and windfall. Your quality of life won't drop, but your net worth will skyrocket. But what if something breaks? What if you lose your job? You can't pay the mortgage if you have no cash. In Part 7, we'll talk about the emergency brake. Why you need cash to kill debt. Welcome to Part 7. Imagine this. You have $200,000 in home equity, but your car breaks down and you have $0 in the bank. You are what we call house poor. The problem with aggressive mortgage payoff is liquidity. Once you put money into your house, you can't get it back out easily to buy groceries or pay medical bills. Murphy's Law states that anything that can go wrong will go wrong. If you lose your job while aggressively paying down debt, that mortgage payment becomes a ticking time bomb. Before you go all in on your mortgage, you need an emergency brake. This is a separate savings account with 3 to 6 months of living expenses. Cash, liquid, safe. This fund isn't an investment, it's insurance. It allows you to attack your mortgage without fear, knowing that if the world falls apart, you have a cushion. Now that you're safe, it's time to find more ammo. In Part 8, we'll build the zero-based budget, the tactical map you need to squeeze every dollar out of your paycheck. Welcome to Part 8. Have you ever reached the end of the month and wondered where all your money went? If you don't tell your money where to go, it will leave you. We use a zero-based budget. This means your income minus your expenses equals zero. Every single dollar gets a job before the month begins. Most budgets have leaks. That $15 subscription you don't use, that daily $6 latte. It looks small, but it adds up to thousands a year. Do a ruthless audit. Print out your last 3 bank statements. Circle everything you didn't absolutely need. You'll be shocked at how much you find. Now take that found money, maybe it's $200, maybe $500, and add it to your automatic principal payment. You just gave yourself a raise without asking your boss. But there is a limit to how much you can cut. Eventually, you can't budget your way to wealth. You have to earn it. In Part 9, we'll talk about the Side Hustle Accelerator. Welcome to Part 9. We've talked about budgeting, but here is the hard truth. There is a mathematical limit to how much you can cut. There is no limit to how much you can earn. Budgeting is a garden shovel. A side hustle is an excavator. If you want to kill a 30-year mortgage in 10 years, you need a bigger shovel. We live in the gig economy. Driving, freelancing, tutoring, selling online. You can make an extra $1,000 a month starting tonight using just your phone or laptop. Here's the rule. Your day job pays the bills. Your side hustle pays the debt. 100% of every extra dollar you earn must go directly to the principal. Don't spend a dime of it. Is it tiring? Yes, but remember, this isn't forever. It's just for a season. You are trading nights and weekends now for decades of freedom later. We've covered the math and the money, but the biggest battle is in your head. In Part 10, we'll discuss the psychology of debt. how to stay motivated when the excitement fades. Welcome to part 10. You are excited at the start. You will be happy at the finish. But right now, you are in the messy middle. This is where most people quit. Paying off a house is a marathon, not a sprint. After the initial adrenaline wears off, it's just you, the budget, and the grind. You need a way to stay in the fight. You must make your progress visible. Build a giant debt thermometer. Put it on your fridge. Color it in every time you make a payment. Your brain needs that dopamine hit. Celebrate the milestones. When you pay off $50,000, go out for a nice dinner. When you get below $100,000, take a weekend trip. Don't wait 10 years to smile. When it gets hard, remember your why. You aren't doing this for a math equation. You are doing this for freedom, for your family, for peace. But wait, your smart friends will tell you, don't pay off your mortgage, invest that money instead. Are they right? In part 11, we will settle the invest versus payoff debate once and for all. Welcome to part 11. Your financial advisor will tell you, don't pay off a 6% mortgage when you can make 8% in the stock market. On paper, they are right. In real life, it's complicated. The stock market return is theoretical and volatile. Paying off debt is a guaranteed risk-free return. A guaranteed 6% return is something Wall Street would kill for. If the market crashes and you lose your job, having a paid-for house is a lifeboat. Having a mortgage and a shrinking portfolio is a disaster. Risk matters. And then there is the sleep-at-night factor. What is the ROI of peace? What is the mathematical value of knowing no bank can ever foreclose on you? It's priceless. You don't have to choose 0 or 100. Contribute to your 401k match, then throw everything else at the house. Balance your future wealth with your present risk. We have covered every tactic, every trap, and every debate. Now it's time to bring it all home. In the final episode, part 12, we will cross the finish line and paint the picture of your debt-free life. Welcome to part 12, the finale. Imagine the day you make that final payment. You log in, you click pay, and the balance hits $0 or hours. How does that feel? Suddenly, thousands of dollars a month stay in your pocket. You can travel, you can give outrageously, you can retire early, you have regained control of your life. This isn't just about you, it's about your legacy. You are changing your family tree. Your children will see that debt is not a necessity, but an option they can refuse. We've covered the math, the tactics, and the mindset. From the bi-weekly hacks to the side hustle grind, you have the blueprint. Now you need the discipline. Don't let this be just another video you watched. Pick one strategy. Start today. 10 years will pass anyway. You might as well be debt-free when they do. Go get it. If you found value in this video, please hit that like button. It really helps the channel. And if you want to be debt-free, click the subscribe button right here. I'll see you in the next video.